Hey guys, my name is Rahul Shah and I welcome you once again to this YouTube channel where my goal is still the same. It is to make investing accessible and profitable for the average investor. Now let's just get down to business straight away because I think we have a lot of ground to cover today. Today I'm going to have an interesting twist in today's lecture. What I'm going to do is I'm going to ask you to imagine to go back in time to the year 2014 and where you will be given rupees 2 lakh to participate in a stock picking contest where your performance would be evaluated against other competitors, and the blueprint or the process that you will have access to for putting together this portfolio will be the process that we highlighted over the duration of this course. So the last few weeks we've been putting together a process or a blueprint for penny stock investing, and you can use this blueprint to put together a portfolio of penny stocks. So how exactly would you go about doing it, and more importantly, whether this portfolio that you have built using our blueprint would end up doing well in the stock market? What exactly would the performance look like at the end of the 1 year period? So let's find out by putting together a portfolio of penny stocks and seeing how it performed in the stock market in the year 2014. Now the very first rule of our blueprint or our process was maximize your exposure to penny stocks when the markets are cheap and minimize your exposure to penny stocks when the markets are expensive. And to help you with this, I have this chart which is there right in front of you. As the chart highlights, it is the future 3-year returns of the Sensex at different price bands over the last 30 years. So whenever the Sensex has traded at a PE of 16 times or lower, or between 16 and 20 times, the forward returns have been attractive. They have been in higher double digits or even as high as 20% over the next 3-year period. But whenever the Sensex PE has gone up to 20 times or more than 25 times, the returns have been poor. They have fallen to single digit returns. Now back in 2014, when we are supposed to build our penny stock portfolio, the Sensex PE was placed at around 18-19 times, which means that the market was cheap. It was a good time to invest in penny stocks. Therefore, what we will do is we will allocate 75% of the 2 lakhs to penny stocks and keep 25% aside as cash in fixed deposits. So 2014 was a good time to put together a portfolio of penny stocks, and therefore I am allocating 75% of the 2 lakhs to penny stocks because the Sensex PE was attractive and there was a good chance you would have made good money over the next 1 to 2 years. So now out of the 2 lakhs, I am allocating 1,50,000 to penny stocks, and the remaining 50,000 I am putting in fixed deposits. Now there are two ways of investing in penny stocks, which I highlighted in the lecture number 2 of the series. Method number 1 was trying to buy tomorrow's winners, trying to buy those penny stocks which you think will grow the fastest, which are part of industries, which are sunrise industries and are growing at a very fast pace. So you could identify these penny stocks and invest in them. And method number 2 was trying to avoid tomorrow's losers. So the focus here is not to maximize the upside, it is to try and minimize the downside and let the upside take care of itself. The method number 1 was trying to maximize the upside and not focusing that much on the downside. Well, method number 2, which I like to follow, is trying to minimize your downside and letting the upside take care of itself. So I'm going to use 2 financial parameters to put together a list of penny stocks based on the principle that my goal is to avoid the downside and let the upside take care of itself. So principle number 1 was of course inspired, these 2 financial parameters numbers are inspired by Benjamin Graham. Principle number 1 was buying a 100 rupee note for rupees 80 and buying a stock with a strong balance sheet or a satisfactory financial position. Now the reason I've chosen, or Benjamin Graham has chosen these two data points or these two financial parameters is simple. I think two of the biggest reasons why people end up losing money in stocks is they will either pay too much for a good quality stock, they will not value the stock properly and end up paying a lot of premium to a good quality stock, or they will end up buying a bad quality stock thinking that it's very cheap. So these are the two mistakes that you should avoid whenever you're investing in stocks. These are the mistakes that ensures that you minimize your downside and maximize your upside. And what are these mistakes? Not paying too much for a good quality stock and not buying a bad quality stock, irrespective of how attractive its valuations is. So how would you ensure that you're not paying too much for good quality or a decent quality stock? Simple. Buy a 100 rupee note for rupees 80. Now in investing terms, this means that if the book value of a company is rupees 100 or rupees 1 crore, I'm not going to pay more than rupees 80 lakh for that company. It's very simple. The book value of the company is assets minus liabilities. Book value is what belongs to the shareholders. So if on the asset side the company has assets of say rupees 100 crores, on the liability side it has liabilities of 80 crores, the book value of the company is 20 crores, and for this company you should not pay more than 16 crores. Have at least 20% margin of safety buying a 100 rupee note for rupees 80. Why book value? Because I think any decent quality company is worth at least its book value, if not more. So if you are buying a stock at a discount of at least 20% to its book value, you are ensuring that you're not paying too much for the stock and you're buying a 100 rupee note for rupees 80. And second is, if your stock has a strong balance sheet, which means that it's a decent quality stock or a good quality stock and you're not investing in a bad stock. So you also ensure that the debt to equity ratio of the company is below 1 times. A company which has debt in excess of equity is, on a consistent basis, is supposed to be risky, and you should stay away from those stocks. So in order to ensure that you are buying a company which is of decent quality, one of the most important financial parameters is debt to equity, and you should ensure that you are buying a stock which has a debt to equity ratio of significantly less than 1. So these are the two financial parameters that I'm going to use to zero in on the right penny stock. And this ties in well with the theory of inversion, where I'm trying to minimize the downside and trying to make the upside take care of itself. So if you're buying 100 rupee note for rupees 80, you are removing the problem of paying too much for a decent or a good quality stock. And if you're buying a company with a strong balance sheet, you're removing the problem of buying a company with bad quality. So in essence, you're trying to minimize your downside and you're trying to take the upside take care of itself. So that was another point. Now this is the final checklist that I'll have to zero in on penny stocks. Penny stock is of course a stock which is priced at rupees 50 or less, so that will be one of the criteria. Now any company, I think, does not have a proven business model if it does not have a revenue of at least rupees 1 billion. So I'm going to leave out all the companies which have revenues of lower than rupees 1 billion, because I think it's impractical to invest in such companies. It's also impractical to invest in companies which have low liquidity. So a company which has at least an average liquidity, a penny stock which has an average liquidity of rupees 1 million or more over the last 1 year, is what I will consider in my universe. Because if you invest in a company with low liquidity, you will face tremendous difficulties in getting in and out of stock, and it's going to be an impractical investment. The next two rules are what we discussed just now. Buying a 100 rupee note for rupees 80. So a price to book of between 0.3 times and 0.8 times, and a debt to equity ratio of less than 1. Now why price to equity of between 0.3 and 8? Why not consider companies below 0.3 times? I think the main reason for this is the companies which is priced significantly lower than its book value, it's a bad quality company. There is some genuine problem with the company and therefore it's priced that low. So a company which is trading at just 10, 15 or 20% of its book value should be avoided, because there are chances that that's a genuine problem with the company, or as they call in the investing world, there are chances that the company is a value trap. So you should stay out of value traps and try and invest in companies trading at a book value of between 0.3 times and 0.8 times. Now, if you are wondering why the checklist is so small, why only 4 or 5 data points, I think it goes back to the principle or the rule that I highlighted in the previous lecture, where I used the example of a horse racing case study and tried to drive home the point that a lot of data points will not improve your accuracy. Information follows the laws of diminishing returns. Once you have the most basic information that you need about a company or about a horse in a horse racing, that is the most that you will need to make a reasonable guess, the reasonable prediction about the outcome. More data points, more and more data points will not improve your accuracy rate that much. It will only improve your confidence in the horse or in the stock. So if you restrict yourself to a few data points, but very important data points, you have as good a chance of doing well in the stock market as compared to someone who relies on a lot of data points, or who has sort of an information overload when it comes to investing. So to avoid this information overload, you should rely on few data points, but most important data points. And I think the data points that we have on the checklist here are will do the job perfectly well as far as penny stock investing is concerned. So although the number of data points are less on the checklist, I think they are the most useful data points and the most powerful data points, and will help us take a pretty informed decision. So here comes the list. What I have done is I have identified 20 stocks using the data points, the checklist that we had in the earlier slide. These are the companies which showed up on my screener when I ran the checklist, and these are the returns that these companies have given over a 1 year period. All the companies that you see here, these are 20 companies. They back in 2014 they were trading at a price to book value of between 0.3 to 0.8 times. They had debt to equity which was less than 1. Their revenues were more than rupees 1 billion, and the liquidity at the time, 1 year liquidity, was more than rupees 1 billion. So these are the stocks that I could zero in on. What I have done is I have ranked them based in terms of the valuation between 0.3 and 0.8 times. So the company which was the most attractively valued, which was the cheapest to the most expensive, that is company which between the range of valuation is between 0.3 to 0.8 times. Within this range, the company that is the cheapest is ranked number 1, and the company that's most expensive is ranked number 20th. So this is the returns over a 1 year period that you can see. I think there's some pretty good returns out there. Sanghui Movers, Asian Granito, Transformers and Rectifiers, Titagarh Wagons, all giving very good returns. Now on this slide you have the three biggest movers, gainers, and the 3 biggest losers. So Sanghui Movers, Everready Industries, and Mahindra CIE Automotive were 3 penny stocks that performed the best out of the list of 20 stocks. They gave returns of 100 rupees invested, 423 rupees in Sanghui Movers, 520 rupees in Everready Industries, 436 rupees in Mahindra CIE Automotive. And there were companies that did not end up doing well. Of course, there was Opto Circuits which lost, where 100 rupees became 90. Everest Kanto which lost 27%, and Goenka Diamond was the biggest loser which lost 75% of its value. Now the biggest loser, Goenka Diamond, it highlights a very important point of this strategy. This strategy will work best when you use it on a diversified portfolio of stocks. The number of stocks have to be at least 20 if you want to extract the maximum benefit out of this strategy. Anything less than 20 and this strategy may not work well. I believe that the number of stocks that you should have in a portfolio should be a function of amount of effort that you've put into the stock. If you put a lot of effort into learning about a handful of stocks, then you can have a slightly more concentrated portfolio. You can invest in 7 to 8 stocks if you know a great deal about all those 7 8 stocks. However, if you are building a portfolio of stocks where you're relying on few but important data points, then you should spread yourself quite well. You should have a diversified portfolio of at least 20 to 30 stocks for the portfolio to do well. If you're not doing a lot of research on the companies and you think you can do well with a portfolio of just 5 to 6 stocks, that will not work, because there will be some companies that will not perform as per expectations. Therefore, to extract the maximum benefit out of the strategy, the portfolio has to have at least 20 stocks, and which is exactly what we have done in this case. Now the final result. The benchmark index has of course done well in the year 2014. The Sensex was attractively valued then, and therefore there were high expectations that the markets would do well in 2014, and which is what the BSE Small Cap Index has done. In 2014, the BXC Small Cap Index was up 69.2%. But the real test of any strategy is whether it has outperformed the benchmark index in any given year. And I think the penny stock portfolio that we have put together passes this test with flying colors. 100% portfolio of penny stocks where we invested the entire rupees 2 lakh in those 20 stocks would have given 122% returns in 2014. Now that's almost 2 times the returns that we earned from the BSE Small Cap Index. That's phenomenal. I think there are very few strategies out there which are able to do this on a consistent basis, that is outperform the market by a factor of almost 2 times. Now even if we consider that we had a 75-25 portfolio where 1,50,000 was invested in penny stocks, 20 penny stocks, and 25% was set aside in fixed deposits or bonds, which earned a return of just 6% per annum, even then the return was a good 93%, 1.5 times greater than what the BSE Small Cap Index gave in 2014. So I think this particular test of trying to outperform the benchmark index and emerging as a winner in the stock picking contest, the penny stock portfolio has done phenomenally well in this test. A portfolio which was created on the basis of very few simple but very useful, very effective rules ended up outperforming the market by a massive margin. Now a lot of people would put down this performance to luck and not skill. They would think that we just got lucky in 2014 and it had very little to do with skill or a stock picking process. It's possible, but I think the chance of that happening is very low, because the portfolio that we selected or shortlisted had very, very sound logic to it. We had maximum exposure when the possibility of the Sensex doing well was great. We invested at a time when the Sensex was at the start of the bull market, when the market PE was low. Then we did not overpay for a stock. We ensured a huge margin of safety. Buying a good quality stock at a discount to book value is, I think, more often than not, it will give you good results. So we ensure that we are buying stocks for cheap. Then we also ensure that we are buying a company with strong staying power, with strong balance sheet, so that the company is a battle hardened company. It has gone through many cycles, and a company which has a low debt to equity on the balance sheet, I think it has a chance of surviving a down cycle. So we eliminated that risk as well. So we bought a stock at attractive valuations, and we ensure that the underlying company is not a bad quality company by ensuring that it did not have a lot of debt on its balance sheet. Now, one thing that I did while shortlisting these 20 stocks is I removed stocks from the IT industry and pharma industry. Now the reason I did that was because personally I personally do not have a great deal of understanding of IT and pharma, so I took those companies out of the list so that I'm comfortable with the names on the list. But it may not apply to you if you're belonging to the IT industry, or if you're belonging to the pharma industry and have a very good grasp of either of these industries or both these industries, you can have stocks from this sector in the portfolio. But because I did not have a great understanding of IT and pharma, I removed all the stocks that were from the IT or pharma industry. So these small tweaks you can do based on how comfortable you are with any particular industry. So this is what I did, and I invested equal amount in all the 20 stocks, which is what you should do also. And the rest, I think the markets did. Since we were investing in a strong market environment, since we were investing when the Sensex was cheap and it was embarking on a bull run, I think the portfolio ended up doing really well. We tried to take care of the downside, and as I said earlier, the upside took care of itself. So you can think over this. You can have a look at the performance of the portfolio over and over again, and try and pick any holes in it, and any doubt that you have, you can mention in the comment section, or you can write a mail to info@equitymaster.com, and I'll try to answer them to the best of my abilities. But I think this portfolio, the rules that we have created over a long term period, the underlying rules are so solid, and the logic is so sound that I don't see any reason as to why this portfolio may not end up doing well over a 3 to 5 year period. Yeah, so that was all from my side today. So please do not forget to share, like, comment on this video, and I will see you again next time. Till then, take care and thank you very much.